Welcome to our webcast titled Depreciation of Fixed Assets. Is dependence on spreadsheets putting your company at risk? Brought to you by CFO Publishing and by the sponsor of our webcast, Sage. I'm Joe Fleischer, and I'm a webcast producer with CFO Publishing. I'd like to tell you about our very distinguished guest speaker and moderator. Moderating our webcast is Selena Rogers, who is Vice President and Editorial Director with CFO Publishing. And as Vice President and Editorial Director, Selena Rogers sets the editorial agenda for CFO Magazine, CFO.com, and CFO Research. Throughout her 10 years with CFO Publishing, Selena Rogers has researched and written on a variety of topics in business and corporate finance, including performance management, information technology, regulation, corporate governance, strategic decision-making, and yes, fixed assets. I'm also pleased to let you know we will hear additional perspectives later on in this webcast from Grant Griebel, who is Fixed Assets Solutions Engineer with Sage. Grant Griebel has been in the software industry for more than 8 years, helping clients of Sage get the most out of technology solutions for their respective businesses, and he works with the Sage Fixed Assets team and has developed a depth of knowledge on processes, implementation, software use cases, and best practices, many of which he will outline during this webcast. We will first hear from Selena, who will outline the risks that spreadsheets pose in general, and then we will hear perspective from Grant regarding alternatives to using spreadsheets with regard to tracking fixed assets, and of course we will open up the floor to your questions. Now, before we hear from our moderator, I do want to pose the first of our 3 polling questions, and the first of these questions is the following. Has your company's finance function formally addressed spreadsheet risk? Close to 2/3 of respondents have indicated that your company's finance function has not formally addressed spreadsheet risk. With this in mind, this is a great segue into a discussion from the moderator of our webcast. And indeed, it is now my pleasure to turn the floor over to our moderator, Selena Rogers, once again Vice President and Editorial Director with CFO Publishing. Please give a warm welcome to her. Thank you.
Well, thank you so much, Joe, and thanks everyone for responding to our first polling question of the day. I'm Selena Rogers. I'm delighted to be here today to talk about a topic that many finance executives should be thinking about, and that is the risks that are inherent in relying exclusively on spreadsheets to handle critical finance processes in general and for depreciation in particular. I'll start by discussing the topic in more general terms, and then Grant will follow with an in-depth discussion of fixed asset depreciation management as an example of a finance process that is both material to most companies' financial results and vulnerable to spreadsheet errors. Before I get much further into this presentation, however, I do want to make one thing clear. Like many of you listening today, I myself use spreadsheets for many, many tasks. They are flexible and powerful applications that I use all the time, sometimes in ways that were never intended by their makers, I admit. They are terrific tools. But my love for spreadsheets is not blind. New challenges are facing finance functions, and for many growing firms, dependence on spreadsheets may have shortcomings and carry risks that finance executives should consider carefully. Fixed asset management in general is a topic of keen interest to CFOs, and within that context, the management of depreciation is a top priority. Failure to calculate and report depreciation accurately can lead to a range of adverse outcomes, from material under- or over-reporting of the firm's fixed asset positions and related reporting shortfalls and the reputational harm and so forth that flows from that, to tax penalties, to under-informed business decision-making, and much more. There are a lot of factors out there making depreciation management and reporting challenging for finance teams, not least of which are shortfalls in finance IT, the mass of disparate systems and processes that can lead to a constant stream of frustrating and time-consuming manual intervention and reconciliation. Grant will be spending time discussing that issue in his presentation. For the moment, I'd like to open up our discussion today by talking about 3 of the main external forces that are creating challenges in this area for CFOs and their teams. The first of these, the ever-increasing business complexity that every growing company is facing, the shorter time frames in which finance is being asked to accomplish more complex tasks, And last but not least, the trend toward regulatory scrutiny and most particularly rapidly changing regulatory and tax landscape. Before I get into those three forces, though, I want to mention that the reason that we're talking about this topic today is that CFOs are coming to the realization that their choices of analysis tools can contribute to an increased risk exposure for their function and for their firm. One of the most compelling of these risks is the risk of noncompliance with all of the costly penalties and reputational hits that can go along with that. But there are also operating risks that can arise when, for example, a company struggles to gain a complete and accurate view of depreciation in order to manage its fixed assets effectively. So we'll spend time on the issue of risk management throughout the presentation, but I wanted to be sure to highlight it because an awareness of those risks forms an important backdrop for the issues we'll be discussing today. So on that note, getting back to our three main external forces influencing this space, let's spend a moment discussing that first big force that's creating that additional pressure and additional challenges in fixed asset and depreciation management: business complexity. A growing company is by its nature an increasingly complex company, and many finance functions are being called on to support growing complexity with limited resources. External forces that increase complexity include the competitive pressure of a rapidly changing business environment, which in turn causes an expansion of new responsibilities and activities as finance teams start to support that geographic expansion. Merger and acquisition activities fall into this category as well, along with a more strategic role in general for the finance function. Internal forces that increase complexity include organizational and leadership changes, and these changes can expose the risk of relying on an individual spreadsheet instead of a well-documented process that can survive turnover and turmoil. So we did want to be sure to mention those forces. We're certainly not suggesting that complexity can't be managed on spreadsheets, but it takes a lot of effort to develop and maintain sound, proper, and effective spreadsheet practices, and the ease of use of spreadsheets themselves can encourage some sloppy habits, even by the most seasoned finance professionals. So to move on to our second major force, in addition to business complexity, the speed with which finance teams are expected to deliver results adds pressure to all finance processes. Finance teams that once focused primarily on meeting monthly, quarterly, and annual reporting deadlines are increasingly being asked to support a great deal of ad hoc reporting, much of which is expected in near real time, or as close to real time as possible. Various spreadsheet analyses originally created for periodic use with the expectation that there would be the time and the bandwidth to review the structure, quality, and accuracy of those models. These are more likely than ever to proliferate unchecked as finance teams that are lean on resources and pressed for time struggle with intensely pressured ad hoc reporting requirements. This environment leads to spreadsheets that are especially vulnerable to version control problems, hidden data and calculations, insufficient documentation, and what we would call shadow personalization, which can cause significant errors if they're not managed well. So with all of that in mind, I'm going to turn things back over to Joe Fleischer for our second polling question of the day, and then we'll return to our discussion. Over to you, Joe.
Well, thank you very much, Selena. And now we will pose the second of our three polling questions. And the second of our polling questions asks, if you were to leave your company, would your successors be able to access and use spreadsheets you currently manage to conduct required analyses? An overwhelming majority have said yes. However, a plurality have indicated yes, but with difficulty. What this suggests is that there are indeed a lot of risks associated with using spreadsheets to track and manage fixed assets. And it is in this context that we will now continue our discussion.
Well, thank you, Joe, and thank you, everyone, for registering your answers to our second polling question. Moving on to the last major external force, the last of our three that are creating challenges for CFOs and their teams that we wanted to go over today, increased regulatory scrutiny. So, since the major accounting scandals in the early 2000s, there has been a massive push toward increased regulatory scrutiny and far greater transparency in reporting. In his presentation, Grant will alarm us with a reminder of some of the biggest corporate restatements in history, which just happen to be related to fixed asset depreciation reporting. In general, what's happened over the past decade and a half is that widely accepted notions of what is and what isn't routine in accounting that have sort of been turned on their heads. And there was a period of several years where really nothing was routine for finance teams. And a key takeaway for CFO survivors of this era of increased regulatory scrutiny is the desire to de-risk all reporting to the extent possible. And this in turn means that finance and tax departments are especially motivated to ensure that the reality of their fixed assets positions, including fixed asset depreciation, is reflecting in their reporting of those positions, in part because the pain of being wrong can be disproportionately greater than the error itself. And, of course, in part because gaining an accurate view of fixed assets helps managers understand the underlying economic value that's being generated by firms' activities and leads to sounder business decision-making overall. So we mustn't forget that. What overdependence on spreadsheets can do is rob time, attention, and resources from compliance and decision support activities. Now, take this comment about managing critical finance processes using spreadsheets from the CFO of a medical services outsourcing firm. This CFO says, I spent more time building and managing the model and making sure none of the links are broken than I did managing the data to ensure it fit the strategic plan. So, managing the model rather than managing the sort of underlying input, that's really important for CFOs to consider. No large firm sets out to create the world's most complex spreadsheet to track fixed asset depreciation. It just happens over time. It migrates and it grows with the firm itself. And when you're in the middle of it, racing to meet deadlines, it can be really hard to see that you've reached the tipping point of too much risk. But finance executives who speak with us are really eager to reduce that risk and put their time and energy toward more important priorities. So as this VP of Finance says, I want to take the resources out of maintaining the spreadsheet-based model and put them into thinking about the business itself. Like so many finance processes, depreciation reporting and management is a moving target, increasingly more complicated and more challenging to manage as the outside regulatory and tax environment shifts and as growth demands take companies to new levels of internal complexity. Spreadsheets are powerful tools, but a large, complicated, and ungoverned collection of IT systems and manual processes is becoming increasingly unsatisfying to finance teams who are looking to manage and report on fixed assets and depreciation effectively. So it's almost time to hand the floor over to Grant to talk about the ways in which technology can be brought to bear to address the challenge of fixed asset depreciation management and reporting. But before we hear from Grant, there is one final polling question to help set the stage.
Thank you very much, Selena. We're now going to pose the third and final polling question during this webcast, and then we will hear perspective from Grant Griebel of Sage. Our third question asks, how do you expect regulatory requirements tied to fixed assets to change during the next 2 years? What we can see is that 73% of respondents to this question do expect that there will be more regulatory requirements tied to fixed assets. With that in mind, this is a great segue over to perspective from our next speaker, who is Grant Griebel, Fixed Asset Solutions Engineer with Sage. Please give a warm welcome to him. Thank you very much.
Well, thank you for the introduction, Joe, and thank you to everyone for taking the time to join us for today's webcast on eliminating the cost of spreadsheets. We hope to answer a couple of questions in today's presentation. First, we're going to spend some time discussing the dangers of using spreadsheets to manage your fixed assets using some real-world examples and figures. Then we'll talk through the benefits of using a dedicated fixed asset software solution and finish by discussing the entire fixed asset process. So first, why is this topic important? You might be thinking to yourself, well, I'm using spreadsheets to manage my fixed assets now. What should I be worried about? Well, quite a lot, actually. Spreadsheets are a common starting point for most businesses to begin managing their fixed assets. However, as time goes on and your business becomes more complex, your growing business's needs expand, you add additional employees, and the federal tax code continues to become more and more complex. All of the dangers of using Excel become more and more apparent until it becomes a stressful source of major business challenges. Now, keeping spreadsheets up to date can start as a simple process, but then quickly grow into a time-consuming burden as they don't scale well with growing businesses. And as your business expands, spreadsheets become more complex, using various formulas and cell dependencies so you can work with your data. Unfortunately, this leads to one or two individuals being the spreadsheet knowledge holder, and if these people leave the business and take that knowledge with them, it can have major impacts on productivity. Additionally, spreadsheets allow the problem of version control to surface. If there are multiple versions of a spreadsheet being worked on, the consolidation and deduplication of data on each version can end up taking more time than entering the data did in the first place, similar to the CFO quote that Selena shared in just a few minutes ago. And finally, spreadsheets offer minimal security and access control options, opening the door to dirty data due to a lack of control. So why does this matter? Well, for a number of reasons, the first of which is bad data. Bad data means bad reports, and bad reports mean bad strategic business decisions. Next, if you do not have accurate asset counts and values, you may be overpaying on taxes and property insurance. Further, if you have bad asset counts, you may find that you don't have a business-critical asset on hand when it's needed. And finally, while clean data is your best friend and shield if auditors come knocking, dirty data is your worst enemy. So what do these challenges mean to your business? Well, let's examine some real-world examples of how the dangers of spreadsheets have impacted other businesses, starting with Eastman Kodak. A miscalculation on Kodak spreadsheets forced them to have to restate their financial results due to a $13 million error. A very similar situation occurred with Red Envelope. An error in one single cell of a spreadsheet led to a 25% drop in share price due to a miscalculation in their budgets and the cost of goods sold. A spreadsheet led to errors in CECO's construction in progress accounts, resulting in a $1.9 million reduction to net income that had to be spread out over a 4-year period. Long story short, the lack of control and data integrity offered by spreadsheets is downright dangerous. A study by Tuck School of Business found that out of a selection of audited spreadsheets, 64% had errors, 7 of which exceeded $10 million. The Asset Management Resources Group has been assisting their clients' asset accounting efforts since 1989. AMR's research shows that 65% of fixed asset data is incomplete, inaccurate, or altogether missing, while 10 to 30% of fixed assets on the books are no longer owned. And finally, the Spreadsheet Research Group found that 30 to 90% of all spreadsheets tested suffer from at least one major user error. So how can you overcome the risks of spreadsheets? One way is to use a solution specifically designed to manage fixed assets. So let's take a closer look at how these solutions can make Excel headaches a thing of the past. First and foremost, by putting checks and balances on data entry. Anytime manual processes are used to manipulate data, you run the risk of letting bad data into your asset registry due to human error. Most fixed asset software solutions enable you to control the human factor by putting checks and balances on data entry and manipulation, maintaining data integrity, and saving time by automating processes. So let's talk about some of the specific benefits a dedicated fixed asset solution can provide. First, built-in tax rules and regulations not only ensure you're in compliance, but also mean you never have to create depreciation calculations by hand again, preventing human error. Fixed asset solutions also offer the ability to customize fields, not only to meet your need in regards to data, but also to mark if a field is required so that it must be completed in order to save an asset. Or if you want to put an entry mask on a field to limit the number and type of characters that can be entered. Dedicated fixed asset software should also allow you to further control data entry by creating a drop-down list of selections for any field, removing the chance for typos entirely. And finally, a group and user-based security structure allows you to control both what asset data users can see and what they can or cannot do when interacting with that data. You don't have to take my word for it. We surveyed our current users to ask them their main reasons for implementing a fixed asset solution, as well as the benefits they found once the solution was in place. As you can see, the main reasons for bringing the solution in were to make the depreciation processes easier and ensure tax compliance. After implementing the solution, customers found that they had saved time on their reporting processes and gained confidence in the compliance of their numbers. We also asked our customers how long it took them to realize a return on investment after implementing their fixed asset solution. As you can see, 71% realized a return in less than 3 months. I think that this quote from one of our customers sums it up best. We had previously been using Excel spreadsheets, which was more time-consuming and had more potential for depreciation calculation errors. Sage Fixed Assets creates our journal entries automatically, and assets are very easy to input and keep track of. Reporting for period end and year end is quick and easy as well. You can see these surveys results in more customer quotes by going to techvalidate.com and searching for Sage Fixed Assets. So, as you've seen, a dedicated fixed asset software solution can make spreadsheet woes a thing of the past. But there's more to asset management than just depreciation. Who's keeping an eye on your assets once they're in use? Are you conducting physical inventories of your assets? Often, when I ask this question to people evaluating a fixed asset solution, I get a response along the lines of, not right now. We want to, and we see that the need is there, but we just don't have the time or resources to put an inventory process in place. And my response is always the same. Do you think that you're going to have less assets when the same question comes up next year? If you think this challenge is unmanageable now, imagine what it's going to look like next year or the year after. The fact of the matter is, putting a process in place to perform inventories of your assets is easier when you have fewer assets to track. And if you already have a process in place, then that process can grow with your business. Solve this challenge before it becomes too large to tackle. Additionally, there's tools out there to help. Fixed asset management solutions can offer both depreciation and tracking options, giving you the tools you need to perform a physical inventory and ensure the information in your asset register is accurate and up to date so you can confidently run depreciation calculations on top of it. But what are the costs if I'm not physically tracking my assets? Well, if you're not performing a physical asset inventory, you may have ghost assets haunting your books. Ghost assets are any assets that you have on your books but can't physically find, and they can have a very real cost. Let's walk through a potential example using some hard numbers and industry averages. In this case, we assume a number of averages to apply to our costs. We assume an average federal tax rate of 30%, a state tax rate of 6%, property tax rate of 3.4%, and an average insurance rate of 1 cent per $1. Assuming these averages, we can now define the asset information. In this example, we're using the following figures. A total fixed asset cost of $1.5 million, a ghost asset percentage of 15%, and a remaining asset value of 40%. With this information defined, we can go ahead and begin to do some math. In this example, we can see a total cost of ghost assets equaling $225,000 with a remaining asset value of $90,000. We can then calculate a potential federal and state tax overpayment based on those ghost assets, totaling $32,400. We can also calculate a potential personal property tax overpayment and insurance overpayment, totaling $5,310. The total potential overpayment due to bad asset data in this example comes out to $37,710. Keeping a close eye on your assets doesn't have to start after they're already placed in service. Fixed asset software solutions offer a planning tool, usually, designed to help you manage your works in progress. These solutions enable you to set budgets for upcoming projects and the individual assets that make up the project, and then compare them to your actual expenses as the project moves forward. Fixed assets planning tools will help you manage ongoing projects by keeping a close eye on budgets and timelines. And when it comes time to finalize a new asset or assets and place them into service, generally speaking, these planning tools can create a historical record and then send the asset right into the asset database to keep an eye on that new asset throughout its useful life. So, as you can see, spreadsheets can have a very real impact on your business. Now I want to go ahead and pass it back over to Selena, who's going to start off the question and answer portion of today's presentation.
Well, thank you so much, Grant, for delivering that presentation. It's really interesting to hear what you're working on. We're starting to take in some questions from our audience, so let's get started and dive into some of those. So one question coming in from our audience, one of our audience members, has to do with, how you know when you've reached that tipping point where you really have to start thinking about a dedicated solution for managing fixed assets and depreciation as opposed to trying to manage this across spreadsheets. So one person writes in and says, how big does my company have to be before spreadsheet risk is relevant to me? And, that may not be, Grant, completely a question of company size, but also other factors that can influence when a company is ready to start making that change. So your thoughts on that would be most welcome.
Absolutely, and I think you kind of hit the nail on the head there, where it's not necessarily a factor of size, although that does play into it, but it's more an issue of process. Depending on the processes that you put in place and the number of people that are involved in those, you might be able to use spreadsheets for quite some time without it having a major impact. However, I usually tend to find that as soon as more than one person is having to interact and manipulate data on a spreadsheet, that's when you start to see these errors come in. As soon as that need goes beyond a single person working off a single document, trying to control the multiple versions that are out there and the different ways that people put data into spreadsheets is where these problems start. And as soon as they start, if they're not solved immediately, they can grow pretty quickly. A single error in one cell of a spreadsheet that's dependent on different formulas within that spreadsheet can have major repercussions. So as a general rule of thumb, I'd say anywhere around 200 plus assets, or as soon as you have multiple people interacting with a single spreadsheet, it's time to take a pretty close look at that process to make sure there aren't errors creeping into your data.
Oh, that's a great point, because we have another question coming in on similar lines asking about key indicators or activities that people might use as sort of flags to see that they're reaching that tipping point. So as you point out, 200 or more assets or multiple people interacting.
Absolutely. That's really just a starting point. And the other thing to take into consideration there, too, is, again, the individual needs of the business. If you're a nonprofit and you're not so worried about the tax side of things and you don't have to hand code depreciation calculations into the back end of your spreadsheets, you might be able to use them a little bit longer before worrying about some of that potential data issues creeping in. But if you are a business that's doing business in multiple states and having to deal with various tax laws and hand coding all of that information in by hand, the more manual entry, the more manual build time dedicated to those spreadsheets, the more the chance for error increases. So really, it kind of comes down to how much of these spreadsheets are being put together by hand, how many formulas are being developed in the back end, and how often are these spreadsheets having to be updated or manipulated. As each of those goes up, the chance for error and bad data increases with it.
That makes sense. And, I think that what we're seeing is as companies start to try to move with the speed of business and make changes to their business profiles to respond to changes in the market, to respond to the market in general, that they are more likely to reach that tipping point on all of those fronts more quickly. So I think that's a great point. Along similar lines, we talked a bit throughout your presentation, and I touched a bit on this in mine as well, about how messy processes can really become the kind of underpinning of an overarching challenge with managing fixed assets and depreciation really effectively. We often speak about the challenges in automating processes and how really companies want to avoid automating processes that are flawed. What insight could you offer on that front? What is the interaction between getting processes in order and implementing solutions such as yours at Sage?
Sure, that's a great question, and really process is probably the most important point of this entire fixed asset management process, and it's right there in the name. There are plenty of tools out there to help you manage fixed assets, including just Excel as a base level on up to dedicated solutions. But those tools help you with a process. Those tools don't set the process. They're designed to help you maintain a process and ensure that bad data doesn't creep into it. So getting a tool alone is not going to solve all of your problems. You need to have the processes in place to make sure this bad information doesn't get in, and then find a tool that's going to fit on top of those processes to help you ensure the processes are being performed accurately and correctly. So the two have to go together. They really need to work lockstep, and you need to take one into consideration before the other. And I highly suggest thinking about your processes internally and using those processes to define your software requirements, and then going out and evaluating a dedicated fixed asset solution based on the requirements that have come from your internal process conversation.
I think that that seems like the wisest and most indeed sage advice that you could offer in that realm, for sure. Getting back to some specific questions that are coming in from the audience about your offerings, actually, at Sage. One of our audience members has a question about importing data from existing spreadsheets into a tool like yours. How does that work? And secondarily, we have some other questions as well about the compatibility of your solution at Sage with third-party ERP. So perhaps if you could tackle the first one, importing data from existing spreadsheets into the Sage solution. How does that work? And are there any challenges? Are there any issues with that you've helped your clientele overcome?
Absolutely. So the system does offer the ability to import assets from an Excel spreadsheet or a CSV file. One of the things whenever this is brought up is most of the time when people are looking to move away from spreadsheets to a dedicated system, of course they want to be able to leverage all of the work that they've done within those spreadsheets so that they're not starting from scratch. And more often than not, somebody will say, well, Grant, do you have a template that we could use so we can format our data in order to pull it into your system? And one thing that is very nice about the way that we can import with Sage is you don't need a template. When you actually go to import your information into the system, it's going to show you all of your source information, and then it's going to provide you a listing of all of the available fields within the fixed asset solution, and you map our fields to that existing document. So you can actually take the document as it stands, and then you can tell our software each column and what field it needs to go into. So you don't even have to really do a whole lot of data manipulation to fit it into a template. You can kind of point the system at each bit of data and tell it where it needs to go, and it'll pull it in for you. You can also save those field maps too, so that actually leads right into the ERP conversation. If you're looking to be able to move new assets or GL entries back and forth between a depreciation solution and ERP, the first way that you could do that without an integration would be to be able to export new assets out of that ERP system and then import them into the fixed asset solution. If you can export them into an Excel document and then pull them in, you can create that field map once and then reuse it over and over. So all you'd have to do is export, choose that file, load the field map, validate, and pull it in, and it takes a matter of minutes to create all those new assets. Now, if you want a true integration where there's no middleman, we do have a professional services group here at Sage that absolutely can create integrations to third-party ERPs. I've seen things like SAP and Microsoft, PeopleSoft, Great Plains. There's a very large number of third-party systems that our internal group has created integrations for, both to pull new assets out of a purchase order solution part of the ERP, or to go ahead and send the GL entries generated by our fixed asset solution back into the general ledger located in the ERP. So it's something we're very familiar with and have done a lot of work with in the past.
Excellent. I mean, I think that's really a key question for so many people, is understanding the sort of compatibility of your solution with existing solutions and systems. So great set of points. Another question coming in that we see very often from folks in our audience is, you mentioned that you have some information about the ROI and the time horizon to return that some of your customers are identifying. Can you speak more about building the case, the business case for this kind of investment, and any advice that you can give our audience on how they can make a strong case for the return on these sorts of solutions? I think would be very welcome to them.
Absolutely. When talking about the depreciation side of things, the return is really going to be more of an opportunity cost, unless you are leveraging an outsourced accounting or CPA. If you're leveraging a party like that, then you're already paying quite a bit in order to have somebody else take this portion of your business and take it off your plate. You can immediately look at a return on investment by bringing that in-house, by no longer paying that third party to do that for you, as well as we discussed, being able to leverage all of the work that third party's already done and importing that information into the fixed asset solution so that you can go ahead and take it and run with it from there. If you don't have a CPA and are doing this in-house, the opportunity cost there is that you're developing all of this by hand, that you're building out all of these formulas, that you're doing it all on your own. And as we kind of talked about earlier, there's a lot of potential dangers that come with that, in addition to the opportunity cost of doing it by yourself. So from a depreciation standpoint, a lot of the value that's coming back is saving the time that it would usually take to do these processes manually, as well as having the confidence that all of your information and calculations are going to be correct and the IRS is never going to come knocking on your door. The other half of fixed asset management is the actual physical tracking of those assets as they're going through their useful life. And that, I mean, we talked about a very direct return on the investment there, and that one is absolutely much, much easier to make a very black and white case for. Almost every business out there, if they have not performed a physical inventory before, on average, 30% of their asset data is bad, and 15% of it is non-existent. If you're paying taxes and insurance on those assets that are not giving any value to your business, the ability to remove those assets from your registry and not make those additional payments will show you an immediate and hard return on your investment to your bottom line.
So that actually brings up some interesting points. And one of the things I thought most interesting in your presentation was this mention of an interest in or desire to conduct a kind of physical audit of fixed assets and all the obstacles that get in the way of that. And that really points up the kind of link between the physical world and the financial expression of that world in the fixed assets realm. In your experience, Grant, you mentioned the sort of costliness and the prevalence of ghost assets on the books. Can you speak more to how common that is in your experience when working with clients, and what kinds of returns companies are seeing when they start to really engage with that, identify some of these ghost assets, and get them off the books?
Absolutely. I mean, like I mentioned, we've actually got research here from some of the third parties that we work with who can go out and actually provide inventory services. So as I said before, sometimes when we bring this up, people say they recognize the need, but it's just too big of a challenge to handle on their own. So we have some parties that we work with that can go out and actually set everything up for those clients who don't have the time and resources but would like to bring somebody else in to handle it for them. So those groups are the ones that we pull this research from, and that's all they do. And they've told us that, again, 30% of asset data at a company who's never done an inventory is wrong. So you have up to 30%. When you look at your parts, plant, and equipment line on your balance sheet, potentially 30% of that number is no longer providing a value to your business. And 30% of that number you're paying taxes and insurance on for no good reason. And that's really where that hard benefit comes from. And it's very, very much a true issue. We have the research to back it up. And a lot of it comes because people recognize that it's a challenge, but it's a big challenge and people are scared to jump on it. And that problem just grows and grows and grows until it becomes a major issue, and then it's a much more difficult problem to solve Whereas if somebody would have looked at that problem when they were getting started and they didn't have as many physical assets to take care of, if they would have put that process in place then when it was a manageable problem, then that process could grow with their business and they'd never run into the part where they've got 30% bad data or non-existent assets on their books. That's about it on that. It's just one of those things that the sooner you can get a hold on it, the sooner you're going to see a return, and also you'll be able to avoid challenges in the future.
That is really one of the most extraordinary things, is that the scalability of the issue, and the fact that if companies start to track these things and get control of these processes sooner, then they can avoid a lot of difficulties in future.
Absolutely.
That is really very interesting, and particularly when we see so many firms really struggling to keep up with the pace of business and keep up with the speed and the complexity with which their businesses are growing. I think that is a very interesting point. Given that all of this is the case, and 30% of assets on the books not producing value, but producing plenty of payments to taxing authorities and to insurers, given that may be the case at many companies, how difficult is it, in your experience, to bring the case to top management to get that kind of top-level buy-in that so many finance executives are looking for? What is the best way, or at least some of the good ways in your experience, to get the attention of senior management and get them focused? Because if you think of it in a certain way, you can't really get into a position to do that physical audit and to really understand flaws in the process without getting some kind of investment and some sort of endorsement from senior management that this whole initiative is worthwhile.
Absolutely. And, I think it's pretty easy to put together on the tracking side anyways, some hard numbers. You can actually do some math there to show to upper management and say, hey, this is what we're leaving on the table right now conservatively. So as I mentioned, the research shows 30% is the high end, 15% is the low end of asset data that's found to be incorrect. So you could even use the low end. You could say, I'm going to go ahead and look at my balance sheet. I'm going to look at the plants, property, and equipment line, and I'm going to see what is 15% of that total value. And then if I were to go ahead and run that number that I get against all of the insurance and tax rates that we're currently paying, you can come up with a hard number that you can share at that point and then say, hey, this is a conservative estimate of the amount of overpayment that we're doing because our physical information on our assets is bad because we have no process in place. So that one's a little bit more cut and dry. You can actually do the math and say, here is a hard number that we can look at, and I can show you my methodology for arriving at this number. Mm-hmm. On the depreciation side, it's not quite as black and white. That one's a little bit more about the fear side of things, the uncertainty, because it really depends on your processes and how many of them are manual. So at that point, you really need to go ahead and look at the opportunity cost. How much time are people spending on building these spreadsheets, consolidating, creating the reporting, and everything in between? And then take a look at the time and say, for all the time that we're spending to do this, how confident are we even in the numbers that we're getting out of the back end? If we're putting in an exorbitant amount of time for multiple people to arrive at a conclusion that we're not confident in, that's an issue on its own. So that's something that it's not quite as cut and dry as the return from an argument standpoint that you could bring up the chain as the tracking. But there's absolutely concerns to be levied against any processes put in place for depreciation right now that are manual and involve more effort and less return for that effort. So that's the suggestion I would make on that side. So depreciation's a little bit more process and, hey, or should we be worried about this? Whereas on the tracking side, you can actually do some math and say, here's the potential overpayment that we're doing right now every quarter.
Yeah, that makes a lot of sense. And, I think also it's interesting to think about that two-pronged approach. What can we actually quantify here? And then what traction can we get from pointing out that all of this manual effort and energy isn't really leading a great return from a finance team overall? So I think that's a very, very interesting point. So overall, Grant, if you were to think about the kind of advice, I have a few questions coming in from the audience that are sort of geared toward what advice can you give for the best first steps to take toward mastering fixed assets and depreciation and putting in place the right processes and solutions to really govern and manage those fixed assets very well? What are the first things that you would advise a member of our audience to do?
Sure. The first step would be almost every time to do an internal audit of your current processes with fixed asset management. Who's entering data? What is it being entered into? How are the reports run? How is depreciation calculated? At this point, if somebody's asking this question, they currently have something in place. So what is that? Take a very close look at it. What are the strengths? What are the benefits? How many people are involved? What's the amount of time that goes into going through this process? And after doing that internal audit, then you can take a step back and go, well, what are the challenges and what are the opportunities based on what we currently have? Also, I would suggest then doing a 1, 3, 5-year look-forward plan and saying, if we were to take the current processes that we have today and match that against our growth plans for 1, 3, and 5 years, would this process be able to sustain us? What would those challenges be? And what can we do right now to get ahead of them? So the first thing that you always want to do when looking at how can we make this better and should we look at tools to bring in to help us is evaluate that current process, the amount of time it takes, the amount of people involved, and what you get out of it, and then is that going to help you moving forward for the future of your business? That's a very good first step to kind of get people interested and to draw up the requirements of what you might be looking for in a dedicated solution that will help you grow and have your business expand over the next 5 years without any significant challenges coming from fixed asset management.
And as you point out, that whole process is one important precursor to being able to identify the requirements that you might have of an eventual technology solution as well.
Absolutely.
Fantastic. So I think that, overall, there is a clear urgency in this space among our audience. And Grant, you've identified for us some great areas for our audience to focus on and to be concerned with, and some solutions to bring to bear as well. So thank you so much for joining us today. Really appreciate your time.
Absolutely. It was a pleasure to be here, and I appreciate the opportunity. And it was great to get a chance to talk about this topic.
Excellent. Well, it's great to have you here with us, and thank you to our audience for joining us. With that, I will conclude our discussion for today and hand the floor back over to Joe for a few closing remarks. Thank you so much, everyone.
Well, thank you very much, Selena. Before we wrap up, here is some additional information from the sponsor of our webcast. On behalf of our very distinguished guest speakers, Selena Rogers, Vice President and Editorial Director of CFO Publishing, and Grant Griebel, Fixed Asset Solutions Engineer with Sage, we all very much appreciate your joining us for our webcast. Depreciation of fixed assets is dependence on spreadsheets putting your company at risk. Brought to you by CFO Publishing and by the sponsor of our webcast, Sage.